Welcome to After Hours, a Traders Pulse for January 10th, 2025. I'm Tom Hartman, joined by Mike Trade Whisperer Christensen. Tonight, we're breaking down our three favorite market stories. Will the Fed keep cutting rates in 2025? They've already started easing, but will they stay their course? Has Bitcoin topped? Real Vision founder Raoul Pal has a strong opinion. And kind of funny is Greg Miller thinks there's a Ubisoft trade. The bell has rung, so let's get into it. How's it going, Mike?
Doing well, Tom. I do got to say, though, that every time you give me a nickname like that, I have this higher and higher reputation that I have to live up to now. So thanks a lot for that. Let me just say it's going to be difficult to live up to this.
Oh, don't worry. If you fail in my eyes, the nicknames will get worse and worse and worse.
Great. Okay. So it's coming soon. My downfall is imminent.
That's right. Well, this week has been interesting. The start of the year has been interesting. There's just so many things happening inside of the world and inside of different social spheres and political spheres and economic spheres. We only care about the things where there's a trade to be done, right? So I get it.
Where's the market going?
Exactly. Where's the market going? And there's all kinds of opportunities to make money on the things that are happening. The first thing I wanted to talk about is something I always find near and dear to my heart. So this is, will the Fed keep cutting rates in 2025? So the Fed has already started easing, but the idea is, will they continue? So some think that rising corporate debt and slowing growth make more cuts inevitable. And others say that the Fed will hold the line. So I wanted to take a look at a couple of things that people are saying. Just to set the tone here, this is a snippet from an article in Reuters. Where they're saying, Reuters, U.S. corporate debt markets continue to be peppered by new bond offerings on Wednesday as Treasury yields increase demand for debt and push companies to get their funding done now before any further increase in borrowing. The first 7 days of the year has seen some $75 billion of investment grade rated bond supply, the busiest through the first full week of the new year in history. The tally is expected to grow with 3 more corporate and some 8 sovereign and supranational bond offerings set the price on Wednesday, according to Informa Global Markets data. So there's this rush with companies right now in order to get their corporate bonds out, and we can understand why. Yields are rising, and the corporate bond years have to beat the risk-free rate, and so they want to issue it now in order to get that funding in before the rates keep increasing. Which means that the corporations think that the rates are still going to keep increasing, right? That they don't want to wait.
For sure. And I think some of that's backed by the rising credit spreads that we're already observing. If you're looking at the difference between AAA or triple B rated bonds relative to the 10-year Treasury yields, even if the Fed remains at a pause, which is currently anticipated. I think right now there's a 97% chance of a Fed pause in January, at the end of January here. Despite that, yields are rising and that spread is rising as well. So there's definitely a borrow now mentality so that those companies can lock in their rate right now at the longest rate possible and keep their cost of capital as low as possible.
So what I find interesting here is whenever there's a discrepancy between will the Fed cut rates and what yields are doing, right? So when we're talking about yields, for anyone watching, we have long-term yields and short-term yields, right? And so we have long-term yields that are rising, actually even from the 5-year up, they're rising, and the short-term ones, which is where the Fed has most control, are actually falling. There are interest rate cuts priced in for next year, but what's interesting to me, it's just how much. Oh, sorry, 2025. That's right.
Yep.
But what's interesting to me is just how that divergence is happening. Now, on the surface of it, it might look healthy in a sense to have longer term yields to be above shorter term yields. I mean, that's generally what you want, and it's a sign of a healthy economy. But when it's the short term yields are there because people think that there is short term pain to be had, and that the Fed will cut in order to match that, it could be a signal that there's bad things happening within the market.
It starts to look like safe haven. Obviously, the expectation would mean that the yield an investor could get on corporate credit or treasury yields would be greater than the anticipated return in the market. So I think I would also be looking for other safe haven vehicles. It's going to be interesting to see what impact this will have on TLT, or effectively going long the interest rates from a Fed perspective, but also what impact it would have on gold. And then I guess the question would still be open on Bitcoin. So maybe we can unpack that as well.
So let's, in order to set the field there, I wanted to cut to a video here from Danielle DiMartino Booth, who I like, I mean, almost as much as Jim Carson, because she used to work for the Fed. There's not a lot of Fed insiders that used to work there who are very public about what they see coming. So let's just take a quick look at what she has to say and pay very particular attention to the tailwinds that she's describing as what her data is showing inside of the markets. You'll let me know, Mike, if you're not hearing the video.
But we have seen a lot more dissension, if you will, amongst the FOMC members, not only just behind closed doors in the minutes that we get, but also we've seen that, publicly in their speeches here, which I guess is understandable given that we are kind of at this inflection point with rates and no one really knows where we're going to go. So of course you're going to have some disagreement. But how much does that disagreement then become a limiting factor? Does it hold the Fed back from maybe making any sort of changes?
Well, it's an extremely interesting dynamic, right? We had Susan Bowman dissent, the first Federal Reserve Board governor to dissent since Mark Olson did in 2005. So that was kind of an unusual development for 2024. Coming into the January 29th vote, we've got Collins and Goolsbee. They're considered to be doves. Then you've got St. Louis coming on and Kansas City. Those two gentlemen are considered to be fairly hawkish. So you really are going to have the chances. And I think Chair Powell knows this. That there could be dissents on either side of the dovish hawkish spectrum going into 2025. There's a lot to balance, especially because continuing claims really are stubbornly at a 3-year high. And
so that's the first issue. Here's the continuing claims. So there's people who are out of work and continue to be out of work. Those claims are at a 3-year high. Just let's keep that in mind.
Sure, but I want to keep that point. I want to keep that measurement relative to our unemployment rate. We still are at a very low unemployment rate of 4.1%. So while those continuing claims are still stubbornly high over the last 3 years, the unemployment rate has been low. Again, this sort of fuels the uncertainty around where we go in 2025, but we can circle back to that point.
Exactly.
Large bankruptcies coming in at 18 for the month of December, the worst December since 2009. We really haven't seen a dissipation in that bankruptcy cycle throughout 2024. In fact, it looks
just the bankruptcy cycle. It's the highest it's been since 2009. So that's, she's mentioning that for the global financial crisis. And that's worrying too. The cycle actually hasn't dipped like we would have expected a dip over the last 3-4 years since the COVID down, but that hasn't been the case. So just keep that in mind.
To be ramping up into 2025. So there's going to be a lot for him to balance on the committee and with incoming economic data, as well as that coming out of the financial markets in corporate America.
I'm glad you brought up the bankruptcy cycle. I, too, have been watching it very closely. BCY on your Bloomberg terminal brings you the bankruptcies that you've seen this year, and the overwhelming kind of amount here, at least a fifth, really. You don't really have anything as close to it as in the consumer discretionary sector. A place where we've seen massive bifurcation. What does this mean? Is this kind of acknowledgement here that you're still seeing a bit of a K-shape when it comes to the consumer? And is there anything that both the Fed or policymakers can do about it?
Well, I mean, we really are getting to the crux of the inequality divide. And I think one of the greater challenges moving into 2025 is that the top of the K is about to get a little bit smaller. Many Americans, about 20 million Americans, have not made a payment on their student loans since March of 2020. So it's been almost 5 years here. And these are some of the higher income earners as well. And they're just now, tomorrow, for the first time, going to be reported if they're in default. So you can actually see one of the upper parts of the case start to weaken going into 2025. And I think that is, again, going to be a greater challenge for the Federal Reserve, because we won't be as bifurcated as we'll be really bottom weighted with people who have run through the credit they can run through, whether you're talking about buy now, pay later, which is on course to be 1/10 of credit card outstanding. It's on course to cross $100 billion early on in 2025. And so the idea of a spent U.S. consumer while some higher income individuals who did not, they didn't qualify for for student loan forgiveness, they're also going to get dinged. And these are debts that cannot be expunged in the bankruptcy courts. And I think that's one of the reasons we're seeing an acceleration on the household bankruptcy side as well.
Danielle, I have a feeling we'll be talking about this a lot heading in.
All right, so that to me is super fascinating. So just to a couple of points there for people who don't know, they were mentioning a K-shaped economy. So we've often heard of a V-shaped economy, the idea that some crisis happens, we have a big drop, everyone falls down, and then the markets go back up. Not just the fiscal markets, but also the economy bounces back. And the K-shaped idea is that while the let's call it the upper 50% of the population, or even higher than that, they bounced up, but the lower end kept going down. And so you have this thing where, on the lower end of the K, you have a number of hours worked for people has gone up, number of jobs per person has gone up, a number of people who dropped out of the looking for employment that has gone up. There's like bad numbers that are shown from there. But the point she's making over here is that the government essentially and the monetary and the fiscal impulses didn't really care, quote unquote, care so much about that, because since we're a consumer economy, what is it, like 70% of the 70% of the consumption actually happens from the top, like 10% of the economy. So as long as that was still there, then we call it still good. It's good for Wall Street. It's good for even though it's not so good for Main Street. Well, now we're seeing where it started to turn, where even the top side is starting to come down. Bankruptcies for corporations, funding for corporations, long-term expectations, uncertainty, spending coming down. And so not just saying, well, now the Fed can't ignore that. They can't ignore where the people who are holding it up, if they're starting to turn down, and that's what we're going to be paying attention to. So she actually calls. I cut off the video a little bit early, but she actually calls for. She doesn't doubt there's going to be rate cuts this year, because the news is bad enough for the people at the top that they're going to be like cut, and we can see even go on to say in other videos that. One of the PCE markers, one of the core inflation markers that they're looking at, is actually down towards 2%, and so that sort of gives them the excuse to go ahead and we can cut into this economy. So it's interesting because you're not going to get the populist demand for the rate cuts in the same way, but you are getting it behind the scenes from institutions, from larger players, and we're seeing that play out right now in the markets with SPY down, NASDAQ down, gold up, dollar up. We've been talking about this now for a couple of weeks now. It's an interesting setup. It's a bad setup for financial markets.
Yeah, I definitely see a lot of that uncertainty starting to get priced in. There's obviously some geopolitical risks that I think people are trying to anticipate around the impact that tariffs may have on inflation. But obviously, we still haven't fully curbed inflation as well. So with rising yields here as well, if people are seeing that from a risk perspective, yields start to look more attractive than the uncertainty in equities markets, that can lead to some selling as well. So I could definitely see that potential. But as I've always said, when it comes to these types of economic forecasts, the signal we'll be looking for will come from essentially the stock market before anything else.
That's exactly right. So I'm wondering now if, so this is the bonds. So we're seeing that the long-term bonds have crossed up and the lower ones are coming down. But what Mike is saying over here is, so the question is, if we take a look at, let's say the SPY, for example, even though we've seen these sorts of drawdowns before, is the idea here that this is an indication to you that this is worrisome, or you're like, well, it's nothing to really worry about until we start making lower lows?
Yeah, I want to see lower lows. At this point, we're still confirming higher lows. And generally, if as I observe the fundamentals, I want to know what the technical perspective as well. From a technical perspective, we're not quite pulling back enough for me to get concerned just yet. As is typically true, it's very difficult to forecast the impact that these things are going to have on markets. We can try to make forecasts all day, but at the end of the day, the opportunity will continue for as long as the trend continues.
So something to remember here, there's something that Mike, you bring up every so often, which is we get it's when volatility is low that you want to pay attention. That's where the kindling happens.
Yep.
And so this is the NFCI. financial conditions index from the Fed, and the idea here is that when we cross this black line, generally speaking, that's when we end up in recession. So it happened in COVID, it happened in global financial crisis and dot-com bubble, that sort of thing.
Right.
And the idea here is that when we see this march up, that's where people are like, oh no, we're worried. And sure, I totally understand, we get that. But you'll notice that it's these lows here that actually precede the big, the big pop. That's where everything seems fine, and then boom, things blow out. And we're now pretty low. Like if we take a look at our current year here,
it's looking pretty quiet, looking very healthy. Even VIX is looking really healthy. In general, as we start to move into 2025, still being below 20 is always an area that I feel is kind of boring. I want to see VIX above 20 for it to be considered. This is short season. This is when we want to move into some interesting short plays, or even just some quick trades across the board in either direction. But yeah, it is a calm before the potential storm scenario for you.
So for anybody paying attention here, the idea here is that the long dollar trade we've been talking about, let's head to the dollar. The long dollar trade we've been talking about has been pretty dead on. Like long dollar in economic uncertainty, take whatever reason you want, it's been a pretty good trade so far, bouncing off these lows. Long gold. So whenever you see gold go up, I love that. Whenever you see gold go up and the dollar go up at the same time, it's not an inflation story. It's a confidence within the financial system story. Because if it was a inflation story, the dollar would go down. And so when both go up at the same time and long-term yields go up, there's uncertainty within the markets. What some people are saying is that now's the time to start putting on bounces. Now's the time to start putting puts, like long dated puts, like say 3 months out, at a lower levels, because you're going to get the lowest premiums that you're going to be paying with the largest potential payout without having to, you're not breaking the bank in order to put some of these positions on.
Yeah, I think that would be the way I would look at it at this point, especially since I'm still bullish the market. I don't see initial signs yet to be too concerned about this current pullback. This looks like a little bit of a healthy short-term correction. So being long puts, especially as they're a little bit cheaper at the moment as volatility is low, seems like an appropriate play while still holding the longs that you're currently in.
That's right. I want to touch on Bitcoin, but let's do that on the next segment. We're talking about Raoul. Just want to make sure. Anything else I want to touch on here? Okay, so yeah, continuing along dollar. The gold trade, I'm a little bit hesitant on, because what happens with the gold trade sometimes is that when, let's say it is a setup we're talking about where you have low volatility, some concerns, we're still near all-time highs, gold's marching on. That could be usually good, but when the actual, if there's a catalyst within the markets that causes a big drop, gold's not immune to it.
Right.
Gold falls
down.
I
think that's true even for crypto as well. I mean, anytime crisis occurs, most assets start to correlate to one, and that's still been true for Bitcoin as well.
Except that for the Bitcoin, you can profit, you get more percentage gains as you're doing the risk up.
Yes,
whereas
that's true.
I feel on gold, you're risking more of that. Whereas if you just actually wait for the correction in gold to happen when there's the whole correlation to one, that's the time to like enter. And I would enter there with calls, because then you get all the sort of asymmetrical upside with the bounce. You sort of know it's going to bounce anyway, because the Fed's going to come in, the central bank's going to come in, print a bunch of money, save whatever system they can, and gold's going to head back up. Gold's not headed down to $1,000 an ounce. Like that's not. I mean,
no,
I don't see that ever happening.
That said, I think there's still more potential for volatility to the upside on crypto relative to gold, especially as the dollar continues to strengthen, which can effectively cap the increased value on gold, just because of that inverse relationship between the two. As people see the dollar itself being perceived as a stable and appreciating store of value, then the idea of just sitting in gold becomes less and less attractive, especially if there's other risk-on alternatives outside of the dollar.
And it's interesting to see dollar up and yields up and gold up. I go, that to me is like such a weird mix to see, because usually when yields go up, you go, well, you just buy the yield because you're like, I want a higher yield if that's what I'm going for. Sure. Why am I trying to hold on to the gold? So usually it's an inverse relationship between gold and yields. But when they all go up at the same time, almost always that means there's storm clouds ahead, and who knows what can happen. Like that's what happens before Bear Stearns collapses. That's what happens before Silver Bank collapses. That's like all that stuff happens. So I'm always nervous when things are like super super calm like this.
Same.
All right, so I want to move off to our second story here. So the question is, has Bitcoin topped? This has been popping up in my feeds all over the place in the trading groups I've been dealing with. And I thought that Raoul Pal's his take was pretty interesting and worth a listen. So we'll break down his latest thoughts that he did on Real Vision and check out some downside targets on our charts. I talk whether or not Bitcoin's bull run is in danger here. Quick second. All right, let me know if you can hear
it. Not global money supply, global liquidity does going forwards. We know back in 2017, the Treasury drained the TGA for the same reason. I mean, it's like literally everything is an exact rerun of what happened. So, look, I don't expect an exact rerun this time, but probabilistically speaking, there's nothing to be concerned over. Now, when we looked at that big M2 drop last time around, this time around, it leads by about 12 weeks. So last time around, we had an identical M2 drop. You can see it. I don't know if you can share that chart you're looking at now, Arthur, that one. So this one shows the near identical pattern in M2 back then versus now. What happened was the dollar weakened, global M2 went up. What also happened is the NASDAQ had a similar correction, crypto very similar. And what crypto did was didn't follow M2 going forwards because it starts to decouple as the bull market takes place. And what happened was it did an 8-day correction and did negative 35%. This time it feels like it's slightly more sideways. Whether it goes a bit lower or not doesn't really matter. But the point being, you're looking for the bottom as opposed to a sharp acceleration from here. But either way, it's over pretty quickly. And then what happened last time around is the moment Bitcoin hit a low, alts took off. And so that's my general thesis on all of this right now. This is pretty much playing out exactly as I've been expecting it to play out. And whether that's in liquidity terms, because it's a rerun, because we've got this debt cycle, it's the same bloody thing, right? So that's my overall view. It's like it's all fine.
Do you think?
Okay, fair enough. And definitely, I think highlighting the cyclical relationship between Bitcoin and the alts is pretty predictable in general. As Bitcoin hits its all-time top, there tends to be these new breakout opportunities in the alts, which can be fairly easily measured. Something that I definitely pay attention to as well. What's your take here, Tom? You're on mute.
All right, I just wanted to bring up something over here, a couple of things to put on the chart, because Raoul goes on more to talk about some of these things. You could always take a look at his video if you're interested. Can you hear me clearly?
Mm-hmm.
Okay, perfect. So the idea here is that he's saying that there was a correction that happened in 2017 where liquidity or global dollar liquidity was headed down, but and Bitcoin was falling, but then before the liquidity bottomed, Bitcoin took off. And the reason he's bringing that up is that he's bringing it up the last time Trump was also in, or around the time where the discussion was in the office. And he goes on to discuss here this idea here. I'm trying to share my screen. And for some reason, the button's not working, so we'll leave it at that. The idea here is that the dollar was also going up then at the same time. And the question here is, there's always Forex games or game theory being played out on the global stage, because the currency is one of the tools or weapons that a country can use against another country, especially if you're the global reserve currency. And so the idea here is that the rise in the dollar, that the America is allowing the dollar to strengthen, in order to put on pressure on foreign nations, especially China, in order to get them to do certain things economically that they need them to do. And that what they'll do once once they capitulate is then head in and now do everything that they need to do in order to get the dollar to go down. Forgive me, I really want to get this thing working. I'm just going to refresh my my chart because I want to show you this on the chart. If you give me a second. Bang. Actually, would you mind pulling up the DXY? Because I can't share my screen for some reason. And what you'll notice is that there are periods where the DXY will rise sharply, and then you'll have like the drop. Like recently, like there's a big. If you put this on the daily, yeah. So on the daily, if you pull out some, perfect. Yeah, if you go to the left a little bit, you'll notice that we had the big rise. Yeah, exactly that big rise from the bottom, and then it dropped down. During COVID, also there was that spike right at the in 2020. There was like so there was that drop, and then there was a drop right before that, where right there where we had the COVID drop, and then previously the one before that, that's when Trump came into office, and then boom, the dollar came down. So the idea here is that it's a carrot and stick situation, that they make deals with other countries. When they acquiesce behind the scenes, then they go, okay, now we can lower the price of the dollar and put less pressure on those countries. So some people are saying that that's what's happening here. That once Trump gets into office, they make the deals, and then now they're going to allow the dollar to fall, and that would coincide with rate cuts, global liquidity coming in, and boom, a skyrocket in assets. Whether that's true or not, I don't know. But what I wanted to bring up is that even though we're getting a downtrend in global liquidity, sometimes Bitcoin rises sharply, even when global liquidity is lower. And Raoul brings up the case of 2017 where this happened. So because this is what we've been looking at, right? This drop going, hey, what's going on? This is normally offset by he said 12 weeks. Some people say 70, so let's call it 7 to 80 days. Mm-hmm. And it actually matches pretty accurately. And if it continues, the idea is that this would mean that Bitcoin would fall to, let's say, around 75,000 if you map it.
Yeah, that lines up with even a technical measurement I've done on that same thing. But I know the other way you've measured this is to pull the liquidity index onto the same chart, but then offset it by roughly 70 days, right?
Correct. Yeah.
So visibility.
I have an indicator specifically for that.
I forgot the offset when I wrote this one.
No, yeah, you can't do it there.
Yeah, I can't do it here. So just looking at Bitcoin, though, like the measurement we're looking to make here is effectively relative to that global liquidity, which is offset by about 70 days. I do agree. I think that there is some potential for a continued pullback here. I was curious if yesterday was going to make a break of this recent support zone at roughly 91,000. We found support there again, but I still think, we could be looking at signs of a short-term pullback that continues, largely just because we've posted a lower high at this point. And it's kind of anyone's guess if this is a continuation from here. But I would expect that if it continues this way, Bitcoin's price obviously continues down and retests this original support level of 74,000, which was the area that I was originally looking at as a break of structure. So if we measure this whole range here from a Fibonacci perspective on the log chart, that also lines up at 0.5, about a 50% retrace at the $73,000 line, which is where I would expect support to show up. And if not there, then a little bit further at the 0618, which is about 66,500 on Bitcoin.
Right. So, and I've been looking at this from essentially, to me, this has been a tale of two channels. Let me just share my screen real quick. So the idea here is that we have this channel headed downwards, and then we have another channel headed upwards. And that's over here. And the idea is we're really at an inflection point in this area. If we break below this trend, Let's call it 94.
Yep.
Potentially, we could be bouncing all the way down to this level here, which is the weekly VWAP that has not been mitigated. So I call that 88,000. But we also have one down here in the 70,000s that we haven't actually gone down to.
Yep.
I find that hard to believe that we get down, maybe a wick, but I find it very hard to believe that we'll get all the way down there because of the timing of things. We also have to keep in mind here, let me just backtrack. So the question here is, have we topped, right? And so the question is, are there any signs that we are at the end of this of the cycle, of the business cycle we have right now? And I don't see that.
Short term, yes, we have topped from this current range. I do think we're going to see a pullback. Where we pull back is the question. Long term, no. I think we're still going to see continued upside on Bitcoin from here.
Yeah, that's what I mean. So Bitcoin normally does anywhere between 30 to 50% pullbacks regularly, even during a bull.
Sure. Yeah, typical drawdowns in Bitcoin are somewhere between 70 and 80% if we're observing the end of an actual cycle, right?
Exactly.
And that has become less volatile over time. It used to be 90% pullbacks. Now we're somewhere in the 70% range. So I think if we're observing a real pullback in Bitcoin in the end of a cycle and the beginning of another 2-year winter, if you will, we're going to need to see a lot more than a 35% pullback, which is what I'm expecting right now.
That's right. And the leading indicators for that sort of thing usually includes with it the setup incentive for the incentive for the powers that be for monetary and fiscal policy to pull back liquidity. And there is no incentive for that. The election's over. The United States wants to take control over some of the conversations that's happened on the global stage. They have the ability to lower the dollar and inject liquidity. They're just not doing it to the extent that we would expect. So we have to assume that they're not doing it because they don't want to do it. And so, to me, all the signs here are pointing that we're just waiting. Let's wait till to see what happens. If we get a sharp correction in the window weakness between mid-January and March, and then come April, I can expect blow off tops. So to me, it's like I'm starting to accumulate leverage long. Everything for me is leverage long. For long positions, and for short terms, I'm just expecting these bounces, and I'm fine if I lose out on the downside. I don't see we're going down to 60 K on Bitcoin.
Yeah, I don't know if it goes that far. I definitely think we're going to see some short-term pullback, which is interesting because I think that lines up with where I believe equities are going. So there's this great opportunity to open some puts and hedge against some of that downside. Interestingly, I think the rest of the crypto market is kind of anticipating that as we look at the BitVol index. And for the last 6 months or so, we've been hovering in this zone of overall volatility around 62, which is fairly elevated to areas where we've seen in the past where Bitcoin is fairly bullish. That volatility has slowly started to tick upward. It's pulling back a little bit as of late, but to me, this is an indication that the options market is still pricing in some future volatility.
I see. Interesting. All right, so I guess I just want to end by saying this thing here, which is something that I have a friend of my best friend, and he's the kind of guy who doesn't follow.
I'm not your best friend, Tom. What happened?
He's the kind of guy who doesn't follow the day-to-days of the market, but when he contacts me and says, should I buy Bitcoin or should I sell Bitcoin, he's a top hit and a bottom signal. He's as reliable as Jim Cramer. Just absolutely fantastic. And I tell it to his face, and he still does it. And when he contacts me and says, and it'll be sometime soon if Bitcoin falls a little bit more, I think I'm going to sell my Bitcoin. I think it'll go down further. Then that's going to be my sensation of, okay, now we've bottomed, which is I'm sure it'll be around 80,000 and move back up.
Those are good people to have in your life. Always take the inverse of those trades.
But the thing that I find so hard to convey to people, I don't understand when people say that, is what is it that you think you're buying? If the idea is that you think this could potentially go to $1 million a coin, why on earth are you selling because you're worrying about a 30% draw or 50% draw? Like,
sure,
if you're a long-term holder, every drop is an opportunity for you to buy more, if that's your thesis.
Well, that's the problem, is that it's very difficult to maintain a very long-term thesis. I know that was my struggle with Bitcoin early on, and it's obviously the biggest opportunity cost in my entire investing career. I just didn't know how to hold long on Bitcoin because I never knew where the future of it was going to be. And remember, I started buying Bitcoin back in 2012 when prices were nowhere near as high as they are right now. So the struggle from here, particularly if you're a long-term holder of any cryptocurrency, is where do you imagine this being in 5 to 10 years then? And that is the hardest narrative to predict, because it's just not the same thing as the narrative of a company. You pretty much know what Coca-Cola is going to do in 5 years from now, right? I pretty much know what Microsoft's going to be doing in 5 years from now. I can't tell you whether Bitcoin's going to be priced even higher in 5 years from now, especially if cryptocurrencies stabilize over time and they become less of a volatile, risky asset, and they become more of a utility in terms of an ecosystem that emerges from this whole new burgeoning industry.
To be fair to you, though, I'm sure you didn't time all your Bitcoin purchases at all-time highs. No. Which is what my friends do. They'll go, it's all-time highs. Now it's the time to buy. It's safe now. I go, this is the exact time it's not safe. What are you even talking about?
Yeah, the one thing that technical analysis has given me the ability to do is time when to start accumulating and when to start taking profits. And I did manage to take those appropriately.
Excellent. All right, so move off to our last story, which is a pretty interesting one for me. This Ubisoft, the sleeper trade. Is it a short squeeze? Is it not a short squeeze? What's going on over here? So Greg Miller from Kind of Funny sees potential in Ubisoft if they announce they're going to go private. But he makes a GameStop comparison that I don't think holds up. So we'll go through some of the numbers, take a look at the short interest and what traders should actually be watching. Now, Mike, the reason I want to bring this up, you might think to yourself, Tom, actually, let's play the clip, and then after that, we'll talk on the other side. It's going to be amusing to me to play a video game clip for Mike.
Because I'm such an avid gamer.
Exactly.
For those who don't know, I never really play video games.
That's right.
Don't mind.
Here comes the money.
Here we go. Money talk.
Here comes the money.
What's up, everybody? Welcome to your favorite reoccurring financial segment on Kind of Funny Games Daily, Greg's Sound Financial Advice. I feel like a year ago and a half ago, maybe 2 years ago, I told you to buy Ubisoft stock.
Did you?
Because it was down. And I was the one who called the GameStop stuff long before that thing. If you would have listened to me, you would have made like 300% of your money.
Do we have proof of that?
We do.
We do.
This is not a bit. That part. The green lights in this thing. This is a bit. But me saying the game, I buy.
Okay.
It was like $1. And it was getting close to be delisted. I was like, no, they're going to sell the consoles. Buy it. And then, of course, the Reddit people did weird things and made it really big. Ubisoft, I was like, hey, we got another shot here. It was like, what, $3.33 when I bought it? I think something like that.
Okay.
And it has continually fallen since then. But now, Kevin, throw it back up. What'd you have there? You had $2.30 cents? Like, again, $2.52. I only have the evidence of when I had my financial windfall from Virgin America. Where I love Virgin America, and I bought Virgin America stock. I was a broke little IGN boy, but I bought as much as I could, and it never did that well. But then when they sold it to Alaska Airlines, I made a lot of money. It like doubled in price.
Yeah.
So theoretically, when they sell Ubisoft, this should double. That's just smart financial advice. That isn't financial advice. Don't hold me legally liable.
He said it.
It's not real, as you see. But is it? Is
great.
it? It could be.
Okay, sure, that's fine.
I love the take. This is not financial, or this is a really good financial advice, but it's not financial advice. Don't hold me legally liable.
So I wanted to show that to make a couple of points here. All right, because we're doing the show not just for our own benefit, but I think it's really important for just regular people who are not like so deep or wonky when it comes to fiscal and monetary policy to actually have an interest in the markets. I think that if you're not having some sort of exposure to the markets, you're sort of really missing out, especially for your kids, because time is such a great asset. You can monetize that within the markets. And the reason I don't have time for play video games either. I think I play one video game with my wife every few months or whatever, but I used to be really into the field. And what I love about the video game industry is that for some reason, like, did you know that the video game industry is like 9 times bigger than the music and film industry?
Mm-hmm.
So people don't necessarily notice that the video game industry is like in 2024 they did $272 billion aggregate.
Mm-hmm.
Music industry did 30 billion, film industry did 81 billion. So it's books, books don't even register. That's how much they're making. And so it's a huge market. They're just like people within the video game industry are just like people within the retail trading, or let's say the beauty, like plastic surgery industry. They're people with money who want to spend it in a discretionary fashion in order to try to get some sort of short-term gain. What happens though when they touch onto the stock market is that they're always anchored onto whatever was the last thing that worked. And this GameStop thing that happened, where they had this explosion with GameStop, had made a bunch of people who jumped on that within the video game industry a lot of money, and they've been wanting the next trade like that. They've been looking for the next thing. And what do they know? They know if a stock in the gaming industry is headed down drastically, and if it's a name that people know, potentially it might be a good trade, either because of a short squeeze or because they might get bought out. So I just want to first put to rest this idea of the short squeeze. Anyone who's watching this, all the kind of funny people, I love you guys. Love everyone in the video game space. I have kind of funny merch on my shelf. I'm really part of the whole crew. There is no short squeeze in Ubisoft.
You need a lot of short sellers and high short interest for something like that to happen. Now, before we did this story, I went and looked this up. And it appears at the moment that there are barely any shares short of Ubisoft on the ADR, which is the ticker UBSFY. That ADR is, of course, the one you would trade in the United States. It gives you the access to the UK listing. So the amount of short interest is tiny at the moment, and relative to the amount of outstanding shares, it's basically not shorted at all. You may as well just say there is no short interest because of how small it is. Right. So as a result, there's no one to squeeze. If you think you're going to get some upside from 31,000 shares that could disappear in one trade, I don't think that's going to happen.
Exactly. So this is what Mike's bringing up over here. 0% basically shorted. Of the 653 million shares, there's like 30,000 that are shorted, which is basically nothing. Contrast that with GameStop. Why that mattered so much is that back in the day, it was like at one point it was shorted. There was like 7% of the stock that was shorted, like billions of dollars worth of short on the stock, and that was part of the thesis.
Even more concerning is that more shares were sold short than there were shares borrowable to short. That actually represented a significant problem around naked short selling and the broker's responsibility to deliver shares, which is still an outstanding problem that I think the SEC needs to solve for. That obviously is not the same story here with Ubisoft. However, I think in this whole setup here, what trade I find more interesting than Ubisoft, because there's always this chance that sure they might go private, and then maybe you've got some upside to selling the shares before they go private. But the acquisition potential is more interesting at this point, especially if they're struggling to start to prove profits. And I know the potential trade here may be more around Tencent. Did you have something to cover on that?
Yeah, that's right. Exactly. So just to finish off the point there, you just mentioned about them going private. Sometimes a stock, when it goes private, the company's being bought out, and the agreement might be a share price that's higher than the one that's traded right now, and that's where you can make that difference. Saw that in Twitter. I think Twitter went up 20-30% on the announcement. So it was like announced in April, and then the stock went up. We've seen that in Store Capital. We saw that in Panera Bread. There's a bunch of examples where this happens. It's not the rule. It's not the rule that just because they're going private that the stock will go up. But if you're going to make that trade, then you want that trade to be around the time, basically as low as the price of the stock you can get. And just because the price is low now doesn't mean it can't drop 50. It can go from $2 to $1, and then you lose 50% of your money.
Interestingly, Ubisoft is still overvalued from a fundamentals perspective, even at this low discounted price. They should. I would peg them at about $2.18 at the moment, and their performance is just atrocious. I mean, they're losing quite a bit of money from a fundamental perspective. They're holding about 120% debt to equity, so it's just not looking good from a fundamental perspective. There is some potential of it continuing to go down, which makes it maybe not a great buy even at the moment. I would want to wait further, but then you risk that chance of not knowing when a private sale is imminent.
That's right. So that is the risk here. So Greg goes on to say in that video that he bought an asset that was low, and then it got bought out and it went up. But just because a stock is down a lot, so the stock is down quite a bit. Let me just put in a line chart. It's down quite a bit. So what is this? 90% from its highs.
Right.
But just because the stock is down 90% of its highs doesn't mean you can't still lose 90% of your money. And this is something that I think some people don't necessarily understand.
Yeah, I can only lose 10% more, right?
Right, exactly. I mean, literally, I've had those conversations with people. I go, no, if this stock goes from $2.46 that is right now down to $1, which is
$2.18,
right?
Yeah. Even if it came down to where I think it should be valued, even at $2.18, you still have quite a bit to lose.
Exactly. And the idea here is that you're then banking on the idea that whatever company is going to buy out Ubisoft wants to pay more than the higher share price. They could pay lower, for crying out loud. They could do that too.
It's possible.
And so, yeah.
Especially with the amount of debt that they have in the books, that it could ultimately end up getting purchased for less than its current market value.
Exactly. And so what's floating around right now in the Ubisoft space is that there's a big game that everyone was waiting for, Assassin's Creed Shadows.
Assassin's Creed, right.
Yeah.
My favorite one. I play that a lot.
Oh, really?
No.
I was like, oh, we could have a conversation about Assassin's Creed afterwards. That the idea is that they delayed the game a month, and the scuttlebutt is that they did that in order to push it into the next fiscal year, so that this fiscal year looks good enough in order for them to get bought out at a higher price. So you can't guarantee any of that. Sure, they probably want to be bought out, but you can't rely on that. But if you are going to rely on it at all, you want to time your trade for essentially around when you think that news is going to come out for the private sale, and then you take your risk either way.
It's a risky one. So I want to flip this trade around on the other side, because I just think that Tencent is actually more interesting, especially with its recent pullback. Tencent recently had about a 11 or 12% pullback on news of potentially there's sort of a actually, I can't glean what news actually pulled that one back, but it wasn't around the Assassin's Creed situation. Right. But if they are a potential buyer, they're actually currently undervalued from a fundamentals perspective, and they have a much stronger balance sheet than Ubisoft does. So I would think Tencent looks like a much better play, especially as it pulls back to this current support level. If that acquisition does take place, that's usually great news for the acquiring company, and we could see some continued upside from there. I would peg Tencent somewhere around about $70 a share from here.
Oh, really? So if that's the case, then we're talking about a $70 a share would be 50% increase from here.
Yep.
That'd be pretty good. So a pitch to Greg, this is the trade you want to take a look at. Plus, Tencent already owns like 9% of Ubisoft. And I think 49% or something like that of the holding company that's involved with Ubisoft. Yeah. And so it's likely that they're, if there's going to be a buyer at all, it might be Tencent. But they have their fingers in a lot of the video game industry pies.
That's right.
If you're going to be expressing your interest in video games, your long-term value for video games, you want to go for the big dogs. It's sort of like when Mike was talking about Microsoft or NVIDIA. Like, there's no reason to go for the little no-name, startup AI company when you can make a bundle. You can make a good amount of money on the big dogs.
Yeah, I mean, this is a huge company, obviously, huge Chinese company. They're sitting on $50 billion worth of cash, of course, held in Chinese yuan. But they're a fantastic company from a revenue and earnings perspective, and continuing to do well over the long run. An acquisition like this is well within their domain, the types of properties that they own across their whole portfolio. But to the point, it's still a volatile priced asset. There's still plenty of movement in price to get in on a trade that makes sense.
That's right. Perfect. So that's my help to the video game community. I think we'll leave it there for this week, unless there's anything you wanted to touch on. But other than that,
no. Maybe one last point is that even if Tencent doesn't buy Ubisoft, it's still a much better looking buy than buying Ubisoft.
Agreed.
Right.
And I love the idea of people, you use your interests and then find a way of profiting off of that. In the same way that people who collect comic books, they'll sell their books around the time where a movie was going to be released during the whole phase 1 and phase 2 of Marvel. That was great. Turn your hobby into something that could actually make you money. And this is how I always pitch it to my kids whenever they're like, oh, I'm really interested in this. Okay, what's the trade? Like, what is it? How are you going to express the idea in order to make money off the thing?
That's right.
So maybe better be careful. I don't want them to get into gambling or sports betting or anything like that. But just in regular life, sometimes you just want to bet on.
A lot of people can still make a bad bet, so be careful and be aware of that. Obviously,
that's right.
I do want to highlight a customer comment here or a visitor comment. Nelson says that it's anyone's guess as what the Feds are going to do, stop or lower it. I agree. It's usually uncertain what the Fed is going to do, but the one guiding indicator we usually look at is what the futures market tends to express in terms of where they place their bets. And if you've looked at the CME FedWatch tool at all in the past, you'll find that it's an incredibly accurate indicator in terms of where the market thinks the Fed's going to land based on economic indicators. And so far, I've been looking at the FedWatch tool for maybe 5 years now. And I don't think there's been a time where if the confidence level is over 80%, that the futures market has been wrong. And at the moment, it's a 97% chance that they're still going to continue to pause. So I would say take a look at that tool and see what your thoughts are on that.
And Nelson, I got to push back a little bit over here. One, Mike is right that the Fed actually listens to what those probabilities are because they don't actually want to have a big discrepancy between what they're doing and what the markets are expecting. Their whole point is to lower volatility. So if they don't match what the percentages are, even if they didn't want to pause, if the market's pricing that in, they sort of want to leave that there and sort of forward guide what they're going to do in the future. But on the long term, we know the Fed wants to be at 0%. They're at 0% for 15 freaking years. They only got off of 0% after inflation started rising, and they didn't even do it at the beginning. They waited till inflation was like freaking double digits before they started raising rates. They
probably waited too long, no question. Yeah.
They want to be at zero rates. Hell, if they could be at negative rates like some of the countries in Europe, that's what they want to be. They want to be as low as possible in order to finance what the government is doing. So we know what the Fed wants. They want lower rates as soon as possible. And so that as a long-term bet, I think is pretty safe until the system collapses. And then, rates are going to 100%.
Well, this has been a good one, Tom. Thank you so much.
Excellent. So that's a wrap for us here at After Hours at Traders Pulse. We'll be back next Friday with more market breakdowns. Make sure you follow us on X. Our links are in the description for Mike and I. And don't forget, like, subscribe, and hit the notification bell on YouTube channel so you never miss another episode. We'll see you next time.
Cheers, everyone.